Yeah, we're going to go right into it today, guys. One of the things that I know that plagues most people when it comes to buying a house is their credit score.
Absolutely.
So that's the number one thing we're going to talk about today. So let's get into the importance of credit, what people should do if their credit is poor, and what are some good credit habits they need to keep up if they're already in a good credit situation.
Absolutely.
Yeah, so I think one of the things with credit is a lot of people shy away from wanting to even know where it's at. Most of the people you ask, they're not really in tune with what credit is. But nowadays is very accessible to be able to, check your score by going on to Credit Karma, your banking app, and all that. But the biggest thing is just knowing the pulse of where your credit score is, and that starts by just checking it.
Exactly. You know what? Most people also don't know that you can run your credit one time for free. And it's actually at annualcreditreport.com. So and we could put that on there, annualcreditreport.com, and it'll give you good detail information as to what your current scores are, what's currently in delinquency, what's being paid on time, et cetera. So it's going to give you a good information to start understanding, where your credit scores are at. Very important.
Now, I know sometimes when we run people's credit score, they go, oh my gosh, it's lower than I thought. And then you go, okay, well, let's look at the report. And there's things that are maybe they're errors or mistakes that were made, or maybe something that's been taken care of, but the credit bureau hasn't taken it off their credit report yet. Or maybe they also have a common name with someone else who might be, look, William Flores is a pretty common name. And so, if you find yourself in that situation, this is a good time to go and correct some of those things well before it's time for you to get into a loan approval and get into a home.
It's so true, Andy. A lot of times, we name our children after us. We're juniors. And so they almost inherit that credit history, which in a lot of times as a parent, if we're not paying our stuff on time, it does negatively impact that child.
Yeah. So let's talk really quickly about what are kind of like some of the rule of thumb for, let's say, credit ranges for people who want to qualify. So I want to start with what we do the most often, which is VA. Now, what would you recommend someone be in the range of credit score wise if they want to qualify for a VA loan?
Well, minimum, the lowest I would say is 640. 640 would be a good start. A great start would be 680, right, Brian? Mm-hmm. So anything below that, 640, is just challenging the credit. The interest rate for that credit score is not going to be in your favor. So the better the credit score, the interest rate's going to be more favorable.
Yeah, to Will's point, I think it's important to understand that your credit is going to dictate your interest rate. So, even if you come in with the minimum threshold, that's not going to give you the lowest interest rate. So it's best to have, as high as possible. 680 is a great starting point to get, those better terms. Once you're in the 700, 740s, you're getting top of the top terms. But I think it's important to understand that, you can get in with the minimum, but you're also not going to get, the most favorable terms.
Yeah. So let's talk about FHA real quick too, because what does FHA need a borrower to be at these days? Is that also at that 620 mark, or more like 640 to be better off, right?
FHA, I believe, is a little interesting. I've done one at 580, although I don't recommend that you want to buy a house at that type of score. But again, FHA allows you to have more debt, have a lower threshold, but if you want to have the least road of resistance when applying for a mortgage, getting approved, minimal verification, or just questions about your application, you want to apply with a higher credit score. Again, the lower tier minimum entry is 580, but again, it's not guaranteed that you're going to get approved just because of that.
That's correct. As a matter of fact, today we just approved a client with a 547 credit score. It was a 660 purchase price with $400,000 down. So the max that allowed for their income was a loan amount of 260, and it was FHA was like 38 over 56% back end ratio
for debt to income.
Debt to income. So we want to always stay within 46.99% over 56% is when we're getting approvals.
In the case where maybe the credit score is really low, I know in the past there have been exceptions, right? There's certain other conditions that might come up if you have less than a 720 or less than a 680. So is that the case here too? A 547 score, but it's got some other conditions?
Absolutely. So in this case, since we do work with several investors, we have to find that investor that has an appetite for that lower credit score from that 480 or below. Like Brian's.
480?
I'm sorry, 580.
580. I was like, whoa, 480. A four handle on the front. I don't know about that. Yeah. That's the first time I heard that.
Another important thing to understand with low credit scores is the interest rate's going to be much higher than having good credit score. Therefore, because the interest rate is much higher, it takes away from your purchasing power. And for every quarter percent, that could be equate to a $10,000 to $30,000,
Difference.
loan amount in difference.
Wow.
Correct.
Yeah, that's a lot. That's pretty substantial.
Exactly.
I want to talk about conventional before we go talk about what people can do to increase their credit score. So where do you want people to be right now for conventional financing as far as credit? What would you say the floor of that is?
I feel for me, if you're going to be using conventional financing, you want to be at a 680 at least, and that's going to give you the best rates for that exact program. Although you can get by with a 640 with certain banks, again, it's just going to be your appetite of how much you want to pay, if that rate is okay with you and that payment is okay with you. But if you have a higher credit score, it's always going to equate to a lower rate.
Yeah. And I know that, for many years, we've been in this a long time. So like 720 used to be thought of as like, oh, if you have a 720 or above, you're good. But that's changed in recent years. So are you guys finding it's more like everything above 740 is all treated the same? Is it 760 or 780? At what height of a credit score does everything else just kind of become the same?
760 and above.
760 and above?
760 and above.
Yeah.
So anything below that, and everything has to do with mortgage insurance. Most people that are going into the entry home, they're putting anywhere from 3 to 5% down. With conventional financing, you could go with 3% or 5%. I always say going with 5% because you get the better interest rate. You don't get that hit for the loan to value. And then in addition to that, the mortgage insurance, the monthly mortgage insurance is based on your credit scores, unlike FHA. FHA, it doesn't matter what credit score you have, you're going to get that 0.55 or 0.85 depending on the loan amount.
Yeah, for the mortgage insurance.
Correct.
Yeah.
Whereas with conventional, it is in your favor. So if you have excellent credit scores, even though the interest rate is still going to be higher for conventional financing, the payment's going to outperform an FHA because it doesn't have the upfront mortgage insurance premium of the 1.75. In addition to that, you'll have a lower monthly mortgage insurance versus the FHA side.
So let's talk to people who may have their credit might feel like it's in the ditch a little bit and they need to do a little bit of work. What are some of the most common things you see with people who have low credit scores and the advice you give them to help get their score up so that they can be in that qualifiable range for VA, FHA, and conventional financing?
Well, there's different scenarios.
Yeah, like I was gonna say, I mean, it depends. If you have high debt, I'd advise go towards the highest interest one first, pay that one down. But if you can bring your debts under 30% utilization, William taught me this trick when I got started in the industry. You're basically able to then bring your scores down. And anytime you start going above the 30% threshold, your scores start to decrease. So knowing that information, if you can play within the 30% the utilization of your credit, it's going to give your scores a higher boost when you're applying for a mortgage. So at the time that you're applying for a mortgage, make sure all your credit cards are either paid down to 30% or below that to ensure that you get, the best terms.
And I know connected to that is the payment history. So, payment history is, I think, obviously, I would like to think it's obvious to everyone that's a really important component, but sometimes we go, oh, it's okay. It's just my my little, line of credit payment here for, my store credit card or something like that. It might seem like it's super innocent, but late payments actually really hurt you a lot. Payment history is the largest weighted factor of your credit score, next to balance of credit used.
Credit utilization.
Those two things together, I know in the past it's been around this, but it's about 60 to 65% of your score's weight is just those two factors, whether you're paying on time and how much your balance that you're using, your utilization.
And to Brian's point, he's absolutely correct. It's 30%. But what we gotta remember is the most important ones are revolving credit. Revolving credit is everything. That means like credit cards. The most important have the greatest impact. And the reason for that is unlike an installment loan, like a vehicle, a student loan, or just, a regular personal loan, with a credit card, no matter you paying off the actual full balance, the credit bureaus will still give you credit history based on that. And that's where the utilization comes in. Whereas with an installment loan, if you pay that balance off, it actually affects your credit in a negative way, because you paid that loan off and therefore there's no more history to rate you on. So that's paid off. It's not like a credit card where it continues to rate you. You didn't use that. That's not a necessary bad thing.
Well, and that's an important point too, is if you do pay something off, you don't need to close the account. It's good that you're paying something off as far as like maybe your score, but if you close that card and it has maybe 5 years of lifespan, you're chopping off 5 years of good reporting credit history that could be aiding you in your score.
That's a great point. Exactly. Do not close credit cards. If you do plan to pay them off, the best suggestion is just keep it open and let the creditor close that account for you.
Yeah, shred the card.
Yeah, shred the card. If
Shred
that's
the
one of
card.
things.
Forget the number.
Well, it sounds like if you, the consumer, closes the card, you get a hit. But if you stop using it after you pay down the balance, wait some time, the creditor themselves have the option of closing that account, in which that at that moment you don't get a hit on your credit.
Exactly.
Yeah, that's
and
smart.
it'll probably hit you, but like, a lot of times we pay it off and we close it off.
Yeah.
So now you close off that history by just closing it off, right?
Yeah.
So paying things off a lot of times actually hurts you in a negative way, and it takes time for the credit bureaus to actually understand your algorithm, how you're paying. Is this person always getting in debt or not? Oh, he paid off all his debt and he just closed it. That's kind of like a double whammy.
So
Yeah.
one of the examples that comes to mind is I've had clients where they're, in the process of getting approved and they're like, yeah, and I'm about to pay my car off. I'm like, whoa, 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 whoa. So if you're in the process of buying and you want to pay your car off so that you can approve more, it's a double-edged sword because you're going to take a hit on your credit. Although your debt to income ratio is going to take a little bit more, make sure that you don't, ding your credit, and then that hurts you in the process.
That's more definitely of a strategy and tactical approach, because on one hand, if the car payment's hurting you and you need to get the car payment off of you to qualify, that's one thing. But if you're using the positive credit history and it's healthy in your favor for your score, that's another. So you might be in a little situation there.
I like that. And so, to your point, Brian, I had a client that in order to qualify, I had to have them pay off their vehicle of $27,000, and they have like $350,000 that they can play with. She's like, "Let me pay this off." And I'm like, there's no need. Wait until you find that home, and then we can figure that out.
That's
Yeah.
smart.
Right.
And so take your time. Fast forward a year and a half, she hasn't found a home yet.
So that's so important because, when we have the conversation with clients, like, yeah, I could go pay it off right now. And I'm like, no. Yeah. Because to the point, you don't want to just pay it off if you don't need to right now. Though it needs to get paid, you don't want to, jump the gun.
The way I look at good credit, guys, is like a healthy branch on a fruit tree. Like, as long as that branch is healthy and it's providing good fruit for you, leave it there.
Yeah.
So wise, Andy.
And, one of the other things, don't rely always on Credit Karma and those credit companies, okay? You got to remember there's such a thing as consumer credit when you're applying for credit cards, right? And then there's going to be, even when you apply for a vehicle loan, it's very distinctive than a consumer credit. And then with mortgages, we're going to really, because it's going to be one of the biggest debts of the consumer's lives, we really have to nitpick everything.
Yeah.
So it's very thorough and it's going to be very different. There's times where we run the credit, the client will tell us, well, on Credit Karma is 640. And I run it, it's like a 7-something.
Yeah.
Well, why is there so different? It's really hard to explain because I don't know exactly what's utilized for consumer credit. And then I've also seen the reverse effect on that, where Credit Karma will be like 780. I run the credit, it's like 680.
Yeah. And it also goes to the point of there might be errors on one credit bureau that there isn't on another. And, again, whether it's the name thing or if it's the way that the specific creditor has reported the activity on your account, sometimes the credit bureaus have errors on the, actually, sometimes I'm giving them a free pass thing sometimes. Oftentimes you'll find that there is an error happening at one bureau or two, and it's not happening all three of them. And you can clean that up, and then your scores will look a little bit more equal. They do not use the exact same scoring model. So if you see 3 different credit scores on your tri-merge credit report, that's normal, but it's not normal if you have a 780, a 777, and a 580. There's something going on there. If you see a huge disparity, that's when you need to ask some questions, do a little more of a deep dive, and find out what may be going on.
Yeah, that's great. One of the most common questions that we have, are you going to pull my credit? Are you going to do a hard inquiry? We do hard inquiries. In order for us to provide it what's called with an AUS approval, we have to run a hard inquiry, really analyzing the full credit. And a lot of people are concerned about that. And I tell them, our thing is, it's better for you to know what you have now and what we can fix if needed. Or if you have excellent credit score, there's nothing really to worry about.
Yeah.
At the same time, maybe there's a card right there that you didn't realize you had such a balance, and now I can really update you on that.
Yeah.
Although a lot of times the credit bureaus take anywhere from 45 to 60 days to update the information. It can be, when we run it, it can be that they've already made a payment. It's not reflected yet.
Yeah, really.
So it just gives you better insight.
Really great point you're making about the timing of that too, because let's say you're trying to buy a house in the next 60 days. Well, if you do find something that's erroneous on your credit report or something you need to address, whether it's in the utilization or it's the score itself, it's the like name and someone else's credit, whatever it is, It may take longer than 30, 60, or 90 days, depending on the bureau and the problem and what kind of evidence you have to submit in order to get it taken off or cleared or whatever. So don't paint yourself in a corner by waiting to the last minute to address these things. Be proactive and do this months ahead of time so that way you can get qualified a little
Absolutely.
easier.
You know, and the credit companies that we've been running credit, they actually have simulators now where we can pay a small amount of fee to tell them what's the potential increase in their credit scores, and it breaks down. Usually, it's always breaking down paying down credit card debt
Yeah.
in order
Yeah,
to
yeah.
achieve that goal.
Yeah.